Hi, everybody. Jeff Yastine here. Welcome to another Market Insight here on Monday, March 9th. And I'm joined by my colleague and friend, as always, Ian King, editor of Automatic Fortune. So, Ian, welcome. Another crazy Monday like we've been seeing recently.
Yeah, it's been quite a weekend. I think it was Lennon that said that there are decades when nothing happens and weeks when entire decades happen. And I feel like an entire decade happened just over the weekend.
And elaborate for us on that. Obviously, we saw the price of oil plummet. We've seen this morning stock futures and the Dow and S&P and Nasdaq indexes open way lower. I think they'll be setting records for a one-day decline. And we've got the Fed in the background cutting rates once last week, and we'll likely see it, if not in another emergency cut, at the next Fed meeting coming up in another week and a half or so.
Yeah, I'm focused on the bond market right now. The 10-year note traded below 40 basis points over the weekend, and the 30-year was below 1%. It's the first time in history that the entire Treasury curve is below 1%. And to me, more so than any other risk asset, this is just a sign of complete market panic. And so if you are looking to buy stocks, this is a really good tell that investors are really at extremes right now with the rally we've seen, especially in the 10-year Treasury note, because investors that don't know what to do with their money, especially from overseas, are coming to the U.S., buying dollars and putting them into U.S. 10-year notes. And the stress on that has just really pushed the yield down, which, in the long run is good for the consumer because rates are lower. And so if you want to take a mortgage out or an auto loan, you've got lower rates in the United States. But, the issue right now we're seeing is just there's this extreme moves in everything, whether it be stocks or treasuries, or even you mentioned a 25% move overnight in gold on news because of Saudi Arabia and Russia kind of walking away from their OPEC deal.
All right, so let's cut to the chase on this. I think you said this already, but just to put a finer point on it, would you be buying stocks on a day like today? I certainly would. I already have, and I've been telling my subscribers at Total Wealth Insider that they need to be, judicious buyers on a day like today, especially for dividend stocks, because they're just being given away. You're not seeing these. You don't often see these kinds of dividend yields. And I think that, especially as you noted, with bond yields now being at all-time lows, never has a bond buyer been paid less to hold that bond than today. And yet you can go out there and look at a stock like Disney, Procter and Gamble, all these big solid companies that are going to be here now, tomorrow, next week, next month, next year, 20 years from now. And you can get these great dividend yields that you can't get in the bond market with only a little bit more risk. What's your thought here?
I mean, I think when you have a panic like this, you absolutely have to be a buyer. The market doesn't give you opportunities like this. I also think that people are worried that we're going to have a recession, but the market really looks forward 6 months. So the market has already priced in a significant degree of recession. Look, we've sold off 20% from the highs already. And before you know it, you're going to start seeing not only monetary policy that's more stimulative. I think the Fed's going to cut another 50 basis points at their next meeting next week. But I also think we're going to hear a lot of talk about fiscal stimulus. Now, whether that be cash to help small and medium businesses get through this kind of slow period caused by the coronavirus, or some other type of jobs program out of Congress, I believe that we are going to have fiscal stimulus this time around, which is a lot different than the kind of quantitative easing and monetary policy we've seen over the last 10 years. So,
right. This is where the government, and it could be easily governments all around the globe, basically open their checkbooks and just start writing the checks for huge infrastructure projects and things like that they know will keep people in their jobs and keep money pushing through their national and obviously the global economies, correct?
Right. And I mean, with 30-year rates below 1%, the U.S. should just say, hey, let's raise a couple $1 trillion right now of a 30-year bond under 1% and then put that to work in the economy. There's no reason why we're not doing fiscal stimulus with rates so low. If people are around the world, investors around the world, basically giving the United States free money let's take it for the next 30 years and do something with it. So I think that is going to be very stimulative for the economy. I think the market is going to like that. And I think that's how we're going to see the kind of turnaround that we've been looking for when we start to hear about a fiscal stimulus package.
I couldn't agree more. And, if you're new to the markets, these sorts of moves can feel very extreme and just can feel like you're having an out of body experience, especially if you've already put money to work at higher levels over the last 6 months, because you're pretty much almost anything you've bought since August, because that's where the S&P is now. It's at where it was back in August of last year. Basically you're either flat or underwater for the most part.
Sure.
These sorts of things are going to happen, and you have to be prepared for them. Mentally, we're here now, and as you were saying, Ian, there is a large set of policy responses from the central banks, from national governments, and talking just briefly about the price of oil. Even though I haven't seen, and I think you said this earlier, about gasoline prices haven't moved that much to the downside yet, but again, at the same time, when oil prices are cut, energy prices are cut, that's also something of a gift to consumers and businesses as well. So if you wanted to see an end to this deflationary scenario, we might even be seeing that right now, even though it may not seem like it, because often, we see, big moves, era-making moves, end in big upside blow-offs and big downside blow-offs. And we saw that with oil back in, what was that, 2007, 2008, when oil went to 140 a barrel?
Sure, Brad, the super spike, which really kind of led to the great financial crisis. But, to your point about being new to the market, for investors who have been around for a couple of years, this is kind of old hat. We had a 20% drop in 2018, but that led to new highs. And that was the end of 2018. In early 2018, we had another 10 or 15% drop, and we rallied off of that. So, my thinking is that you get 13% drawdowns on average every year in the S&P 500 over time. So this is not unlike anything we haven't seen in the past. I think we've kind of been lulled to sleep by the lack of volatility in the last year. But, the good news is that we reach new highs when we kind of shake out all the weak hands and put stocks in hands of longer term investors. So things felt a little frothy earlier this year. Remember, you and I had a conversation where things were so calm, and we also had stocks like, in hindsight, Virgin Galactic that was going crazy, and even Tesla, which still seems to maintain, I think it's still trading around 600. So that's still up. But, when you have these kind of sell-offs, they just act as kindling for the next rally. And we're kind of changing the narrative now to the Fed and also the government being more accommodative, which I think is going to be more bullish for the market in the medium and longer term as we move through the year.
Ian, I don't think I could add anything to that. I think you hit it right on the money. And I know it seems crazy, if you're watching us and you're saying, how can these guys be so bullish when the Dow, and again, it was open this morning down, 1,700 points, 1,800 points. But this is how things work in the stock market. And, whether we get up to new all-time highs, in a month or two, or more like a couple of years, remains to be seen. But the point is, you need to take advantage of these times and start thinking about putting money to work, because this is when you have these moments of extreme fear like we have now, that's the time to go to work. Ian, any last thoughts, and then I'll wrap it up.
I'm just, one other thing I want to note is the CNN Fear and Greed Index is down to 5 and showing extreme levels of fear. So if you haven't noticed it by the market, at least this is what sentiment's saying right now. I'm sure every one of your colleagues and friends are talking about how bad the market is. But that's about it for this week for me.
Yeah, same here. And conversely, we saw the volatility index, the VIX. I know it finished at like 48 or 49 or 45 last week. I haven't looked this morning, but I'm sure it spiked to 50, if not higher. Again, that just shows the degree of extreme fear out there, and you need to be an opportunistic investor to take advantage of these kinds of situations. So Ian, thank you very much for joining me today on yet another Market Insight.
Thanks, Jeff. Good seeing you.
Same here. And for all of you, make sure to subscribe to us on YouTube, and to follow us on social media. I'm Jeff Yastine, wishing you the best of good buys.